Did you know that your income tax benefits could be reversed too? Exciting investments too early could lead to reversal of taxation benefits. So while drawing up a chart of tax-saving investments for the year, it is important to not forget about the conditions that could nullify the tax benefit under Section 80C. With employers dishing out investment declarations form these days, many taxpayers are exploring options to minimize tax outgo by claiming the right deductions under Section 80C. But is that enough to save your taxes? Well, it's not. You also need to be aware of the riders wherein the tax benefits under Section 80C bucket can be reversed. In this video, we are going to discuss some of the points to keep in mind so that you don't have to face the repercussions of your own investment decisions. But before that, don't forget to like this video, subscribe to Moneycontrol channel and hit the bell icon for more such content. So the deductions under Section 80C come with certain conditions. One can claim these deductions when these specified conditions are fulfilled, failing which the entire deduction amount claimed in the previous year will be considered as income for the next financial year. Early withdrawal, expenditure incurred for ineligible purposes, and transferring investments or assets prior to the prescribed conditions are just some of the reasons why deductions that you were quickly allowed can just as quickly be reversed. Let's dive in some of the main points separately in detail. Number 1. Terminating insurance. Often, taxpayers scramble to buy life insurance policies before February to meet the March 31st deadline. What many do not realize is that the premium is not a one-time expense and has to be paid in the subsequent years as well. Many insurance policies require you to pay the premium every year for a few years at least. And if you stop paying the premium for any traditional life insurance plans within 2 years of the issuance, the premium claimed as tax benefit under Section 80C would be reversed. Number 2. Withdrawing from pension plan. Similarly, surrendering a pension plan before completing a premium payment for 2 years too would result in the reversal of tax benefit claimed under Section 80C. Number 3. Limit your premium to avail tax benefits. While choosing a life insurance policy, you must also understand the conditions under which the maturity amount becomes taxable. Currently, the Section 80C tax deduction benefit is available only for those policies where the premium paid is up to 10% of the sum assured. If your premium exceeds 10% of the sum assured, then even your maturity amount is taxed in your hands. Number 4. Home loans. Even for a home loan, the tax benefit is allowed under Section 80C for the principal section of the loan paid during the year. However, there is a stipulation to this rule. The property cannot be sold for 5 years from the time you get possession of the house. And if you do sell your house before the limit, you face the double whammy of losing out on the tax benefit and having to pay capital gains tax too. Number 5. Alteration in tax bracket. A reversal of tax benefit could impact your tax bracket too, as the income could escalate due to nullified tax deductions. Take for instance a person whose taxable income in a year is 4.85 lakh rupees. This means she is in the 5% income tax bracket. However, if she were to withdraw her life insurance policy before the mandatory period and the rupees 45,000 that she had claimed as tax deduction earlier is added to her income, her taxable income suddenly crosses the rupee 5 lakh barrier. In other words, she now falls in the 20% tax bracket. Thus, it becomes really important to declare the premature withdrawals. The question is, if you withdraw your investments after having claimed your income tax deductions, how would the government even come to know of it, or will be able to nullify your tax benefits that you had claimed earlier? Remember, if the deduction claimed under Section 80C is withdrawn, then it will be taxable under the head income from other sources, and the taxability will be according to the slab rate. The onus thus is on the taxpayer to declare such withdrawals. Chartered accountants warn that if you do not, and your income tax return is picked up for scrutiny, you would need to provide all the proofs. And the rate of penalty for that could range between 50 to 200% of the tax amount. One must be careful as many tax investments specified under Section 80C are government schemes. So it becomes very easy for the income tax authorities to collect data and identify the potential violations. Assessees have been mandated to link their permanent account number, that is PAN card number, with Aadhaar card, which aids them to trace all the financial transactions carried out by the assessee. It also becomes really important to preserve your documents. Further, if the income tax department scrutinizes the tax return filed in assessment proceedings, they may also require the taxpayer to submit proof of investments that would enable them to trace the investments. Details and documents for the purpose of taxation, such as investment proofs, rent receipts, salary slips, Form 16, should be maintained for 6 years from the end of relevant assessment year. If an individual has claimed certain expenses deductible in Section 80C in the financial year 2022-23, she must preserve the same for 6 years from the end of the assessment year 2023-24, which would be the end of 2029-30. This means that an assessee should effectively preserve such records for a total period of 8 years. While assessment can be reopened until 4 years, cases of concealment of income of rupees 50 lakhs or more can be reopened until the end of 10 years. Hope this video provided you insights for your future tax planning. And well, for more such content, keep following Money Control.